Welcome back to the Investor's Library. It's 2025, and we're kicking off the year with a deep dive into Peter Lynch's Beating the Street.
Oh, this is a good one.
Yeah, it is.
It's a classic.
If you're new to the investing world, Peter Lynch was the rock star manager of Fidelity's Magellan Fund.
Yes.
Phenomenal returns and a common sense approach.
Yeah, he made some serious money.
Made him a legend in the 80s and 90s.
Mm-hmm.
We actually explored his one-up on Wall Street back in November, so check that episode out if you haven't already.
Right.
But today, it's all about beating the street.
And what's so fascinating is how relevant this book still is in 2025.
Oh, yeah?
One of the things Lynch talks about is this decline of amateur stock picking. He compares it to homemade pie giving way to store-bought.
Okay, I get the pie analogy.
Yeah.
But what's behind this trend? Why are fewer people researching and picking their own stocks?
Well, Lynch points to how the media portrays Wall Street experts. They're almost like these untouchable geniuses, right? It creates this intimidating image that can make everyday investors feel like they don't stand a chance.
Yeah, like keeping up with the Joneses.
Exactly.
Like, oh my gosh, they're such a genius. How could I ever compete with that? But we have technology now.
Right.
We have all these databases and fancy screeners.
Yeah.
But it's almost like information overload.
It is.
Do you think all this data might be leading people to over-rely on numbers instead of doing their own digging?
Yeah, I think that's a valid point. And on top of that, the role of stockbrokers has shifted. They're less focused on giving personalized stock advice and more on selling a whole range of financial products.
Right.
So that individual guidance that amateur investors might have relied on isn't as readily available anymore.
Yeah, it's a different landscape.
It is.
But then Lynch throws this curveball with this story about seventh graders at St. Agnes School.
Oh, yeah, I remember that one.
Who actually beat the market with their stock picks.
That was a great story.
What's the takeaway there?
Well, it's a brilliant example of how anyone, even kids, can become successful investors if they have the right approach.
Right.
Lynch emphasizes that you don't have to be a Wall Street wizard to do well in the market.
Right. And he's a big believer in consistent, disciplined investing.
Absolutely.
Even with small amounts.
Yes.
I was blown away by that example he gives. Imagine consistently investing $1,000 in the S&P 500, starting back in 1940.
Yeah, that's incredible.
The results are incredible.
It really highlights one of Lynch's core principles, long-term thinking.
Yeah.
He stresses that avoiding market timing and emotional decisions is crucial.
Totally.
He even talks about weekend worrying, where even seasoned investors at the Barron's Roundtable get caught up in market noise and second-guessing.
Oh, yeah. I can definitely relate to that weekend worrying.
Yeah.
But speaking of market turmoil, how did Lynch navigate the 1987 crash?
Right.
That must have been a wild ride.
Here's what's interesting. Lynch didn't panic. He stayed calm and saw opportunity amidst the chaos.
Okay.
He even increased his personal stake in certain stocks, going against what many were doing.
That's bold. How did he manage to do that when everyone else was hitting the sell button?
Instead of getting caught up in the doomsday predictions, Lynch doubled down on his research and focused on individual company fundamentals.
Right.
It's a powerful reminder that tuning out the noise and doing your own homework can pay off, especially during times of uncertainty.
So I'm curious, how do these principles apply to us, the listeners, in today's market? It's 2025. Are Lynch's ideas still relevant?
I think they might be even more relevant now. Think about it. The market's more volatile than ever. We're bombarded with information and everyone's trying to sell you the next hot stock tip.
So where do we even begin to apply Lynch's principles in this environment? Where do we start if we want to beat the street like he did?
Lynch was all about personal research. He believed in visiting companies, talking to executives, and even observing customer behavior in malls.
So he used his everyday life to find investment ideas.
Yeah.
I love that. It reminds me of that story about him being in Sweden.
Right. He toured a Volvo factory and realized it was what he called a giveaway stock. The company was sitting on so much cash that it was almost like getting their entire auto business for free.
It's like finding a $20 bill on the sidewalk.
Exactly.
But what makes a stock a giveaway stock?
Essentially, the company's assets or cash on hand are worth more than the entire market capitalization of the company. So you're essentially getting a huge discount.
Wow, that's amazing. And there was that other story about Lynch observing teenagers at the Gap, right? He saw it as a buy signal just from watching shoppers.
Exactly.
Wow.
Or his analysis of Fannie Mae during a time of market turmoil. He saw it as a safe haven, even in a potential economic collapse. He was always looking for opportunities that others might miss.
It sounds like he was a master at connecting the dots between everyday observations and potential investment opportunities. That's a skill I'd love to develop. But let's dive into the stock recommendations in the book. How did he categorize them?
Lynch breaks down his stock picks into several categories. One that stands out is great companies in lousy industries, like Crown Cork and Seal, a can maker, and Shaw Industries, a carpet manufacturer. Not exactly industries that scream excitement, right?
Not really.
Yeah.
But that's why it's so intriguing. Why would Lynch be interested in these seemingly boring companies?
Lynch loved this category because it's full of hidden gems.
But
These companies are often overlooked and undervalued because investors are turned off by their industries, but the companies themselves can be incredibly efficient and profitable.
well, it's about looking beyond the surface and seeing the potential that others might miss.
Exactly. Crown Cork and Seal, for example, was a master of cost control. Their CEO, John Connolly, was known for being incredibly frugal. He saw those lavish corporate perks as wasteful and believed in keeping things simple, avoiding debt, and treating his workers well.
That's a refreshing perspective. It's like he was focused on building a solid business rather than trying to impress Wall Street.
And it paid off. Crown Cork and Seal consistently outperformed many companies in flashier industries.
That's impressive. What about Shaw Industries? How did they manage to thrive in the cutthroat carpet industry?
They became the ultimate low-cost producer. They invested heavily in streamlining their operations, eliminating unnecessary expenses, and even acquiring their own yarn-making facility to cut out the middleman. They were obsessed with efficiency.
So they found a way to win even in a tough industry by focusing on what they could control, their
Yeah.
costs.
Exactly, and they weren't afraid to get creative. For instance, instead of having a fancy showroom in Atlanta, they used a bus to bring customers to their headquarters in Dalton. Talk about thinking outside the box.
I love those examples. It shows that you don't always have to reinvent the wheel to be successful. Sometimes it's about finding ways to do things better and cheaper than your competitors. Now let's move on to another category that fascinates me. Cyclical stocks. Lynch uses GM and Chrysler as examples in the book, companies whose performance is tied to the economy.
Cyclical stocks can be tricky, but incredibly rewarding if you understand how to navigate them. Lynch's key insight is to buy them when they're out of favor, not when everyone's jumping on the bandwagon.
That sounds counterintuitive. Why would you buy a stock when things are looking bleak?
Because that's when the potential for big gains is the highest. You want to buy when the stock is undervalued and sentiment is negative. Then when the cycle turns and the economy starts to recover, you'll be positioned for significant gains.
But timing the market is notoriously difficult. How can you tell when a cyclical stock has hit its bottom and is ready to rebound?
It's not about perfectly timing the market. It's about recognizing when a company is starting to turn things around, even if the overall economic picture is still uncertain. Lynch emphasizes looking for signs of improvement, cost-cutting measures, new product launches, or increasing market share.
So it's about doing your research and understanding the company's specific situation rather than just following the headlines.
Precisely. For example, with GM in the early 90s, everyone was pessimistic about the company's future. But Lynch looked beyond the doom and gloom and saw that their European operations, financing arm, and other divisions were actually doing quite well. This gave him confidence that GM could generate strong earnings even if the U.S. auto market remained weak.
It's like he was playing chess while everyone else was playing checkers. He was thinking several steps ahead. Now let's talk about the final category, troubled utilities. What makes them so intriguing to Lynch?
This category really showcases Lynch's contrarian approach. He sees troubled utilities as potential diamonds in the rough. They've been beaten down by the market, but often have the potential to recover and deliver impressive returns.
So what makes them attractive? They don't exactly sound like exciting investments.
They're not flashy, but they offer a few advantages. First, utilities often operate in regulated markets, which provides some stability and predictability. Their revenues are less likely to be disrupted by economic downturns.
That makes sense. People need electricity no matter what the economy's doing. But what about the troubled part? Why are these companies struggling in the first place?
Often the problems are specific and solvable rather than fundamental flaws in the business model. Lynch points to CMS Energy, a utility company in Michigan that had to abandon a partially built nuclear power plant.
That sounds disastrous. How did they ever recover?
It was a tough road. CMS had to take a huge write-off and convert the unusable nuclear plant to natural gas, but they pulled through, and by the early 90s, their stock had rebounded significantly.
That's a remarkable turnaround story. It shows that even companies facing serious challenges can bounce back if they have the right plan and execute it well.
Exactly. And Lynch argues that one of the best times to buy a troubled utility is when they're forced to cut or omit their dividend. This is often seen as a sign of desperation by investors, but Lynch sees it as a buying opportunity.
So he's looking for those moments of maximum pessimism when everyone else is running for the hills. That's bold.
It is. He believes that if a utility can survive that difficult period and restore its dividend, the stock price is likely to soar. It's all about having the patience and conviction to hold on for the long haul.
I'm starting to see a pattern here. Lynch isn't afraid to go against the crowd. He's looking for those hidden gems, those undervalued opportunities that others overlook. But how does he apply this approach in today's market? He retired from Magellan decades ago. How does he stay on top of things and find those hidden gems?
Well, even though he's not managing billions of dollars anymore, Lynch still uses the same fundamental principles. He emphasizes personal research, visiting companies, talking to management, and observing consumer behavior.
So he's still out there doing the legwork, kicking the tires, and forming his own opinions. That's inspiring.
Absolutely. He's a firm believer in first-hand knowledge, and he's not afraid to look in unconventional places. He talks about finding ideas in his everyday life, from the stores he shops at to the products his family uses.
It's like he's saying investment opportunities are everywhere if you know where to look. He's still a stock picker at heart, even if he's not running a massive mutual fund.
Exactly. And that's what makes Beating the Street such a timeless book. It's not just about specific stocks, but a way of thinking about investing that can be applied in any market environment.
That's a great point. It's about empowering individual investors to take control of their finances and make informed decisions based on their own research.
Precisely. And I think that's especially important today with so much noise and information overload. It's easy to feel lost, but Lynch reminds us that we all have the potential to be successful investors if we're willing to put in the time and effort.
This has been an incredible deep dive. I feel like I'm starting to see the market through Lynch's eyes. But before we wrap up, are there any specific companies that Lynch highlights in the book that you think are particularly interesting or relevant to investors today?
There are quite a few. One that stands out is Sun Distributors, a master limited partnership that Lynch recommended in both 1992 and 1993.
What made Sun Distributors so special?
Sun Distributors owned a diverse portfolio of businesses, glass hydraulics, auto parts, and Lynch believed that the company's Class B shares were significantly undervalued. He predicted that the company would eventually be sold, and when that happened, the Class B shareholders would reap the rewards.
So he was betting on a catalyst, a specific event that would unlock the value of those shares.
Exactly. And he was right. In 1993, just a few years after Lynch made his recommendations, Sun Distributors announced it was considering selling off its divisions. The Class B shares skyrocketed, validating Lynch's thesis.
That's incredible. It's a great example of how understanding a company's structure and looking for potential catalysts can lead to big wins. Are there any other companies that come to mind?
Another one worth mentioning is Tenora, a company that provides utility management services.
What's the story with Tenora?
Tenora was a bit of a turnaround story. They had faced some challenges in the early 90s, but Lynch was impressed with their debt-free balance sheet and believed they had the potential to recover.
So once again, he was looking for a company with a solid foundation that had been unfairly punished by the market.
Precisely. He also liked that Tenora was buying back its own shares, which he saw as a sign of management's confidence in the company's future.
It's always a good sign when management puts its money where its mouth is. So how did Tenora perform after Lynch recommended it?
It's a bit of a mixed bag. The stock price did go up initially, but then fell back down. By the time Lynch wrote the book, the price was roughly the same as when he first recommended it.
So not exactly a home run, but it sounds like the story wasn't over yet.
Yeah, right. Lynch remained optimistic about Tenora's long-term prospects, citing their new COO growing client base and efforts to resolve outstanding issues.
It's a good reminder that investing is a marathon, not a sprint. Sometimes it takes time for a company's turnaround to fully play out.
Absolutely. And it also speaks to Lynch's patience and willingness to stick with his convictions, even when the market doesn't immediately reward him.
This has been an incredible deep dive into Beating the Street. Peter Lynch's insights are as valuable today as they were decades ago. It's clear that his approach is all about thinking differently, looking for those overlooked opportunities and having the courage to go against the grain.
I completely agree. His book is a must-read for any investor. It's packed with timeless wisdom and practical advice that can help anyone navigate the complexities of the market.
Now, before we wrap things up, I want to highlight a few actionable takeaways that our listeners can apply to their own investment journey. What's the first thing people should keep in mind?
I'd say the most important thing is to know what you own. Don't just buy a stock based on a hot tip or because everyone else is buying it.
Do your own research. Read those annual reports. Visit the stores. Talk to management if you can. Really get to know the company you're investing in.
And don't be afraid to invest in companies that are out of favor or in industries that aren't considered sexy. Remember Lynch's love for great companies and lousy industries. Sometimes the best opportunities are hiding in plain sight.
That's a great reminder. It's about looking beyond the hype and finding those undervalued gems. What else should investors keep in mind?
Avoid long shots.
Yeah.
Don't chase those speculative investments that promise unrealistic returns. Stick with companies that have a proven track record, a solid business model, and a clear path to growth.
And remember, one of Lynch's most memorable pieces of advice: owning stocks is like having children. Don't get involved with more than you can handle.
I love that quote. It speaks to the importance of building a focused portfolio. Don't spread yourself too thin. Concentrate on a manageable number of companies that you truly understand and believe in.
It's about quality over quantity. And finally, be prepared for market downturns. They're a natural part of the investing cycle, but they can create fantastic buying opportunities.
Exactly. When the market takes a dip, don't panic. Use it as a chance to add to your positions in those high-quality companies that you've been following.
It's all about staying calm and sticking to your long-term plan. This has been an incredible deep dive into beating the street. Peter Lynch's insights are timeless, and his approach to investing is as relevant today as it was decades ago.
I couldn't agree more. This book is a must-read for anyone who wants to take control of their finances and build wealth through investing.
And to our listeners, we hope you've enjoyed this deep dive into beating the street. Remember to keep exploring, keep learning, and keep beating the street. Thanks for joining us at the Investors Library.